Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi ho, it's Mr. Michael Becker. How are you?
Hey, Paul, doing pretty good. Just, trying to make sense of the world today.
It is becoming more and more complicated every day. Interest rates going up, cap rates going down, maybe tenants' rents going up. Everything is in flux. So somebody that we always try to bring in and give us some answers to all these complicated questions is our friend JP Conklin with Pensford. And you know JP because he writes that very interesting Pensford letter that comes out. We want you to download that, become a friend of Pensford, understand where interest rates are going, because JP has the inside information. So we try to get him to tell us everything that he knows. So, Michael, I'm going to turn it over to you, and let's spend some time with JP.
Yeah, JP, maybe you've been on the show multiple times now, so most people probably know you. But for the benefit of those that haven't heard you speak, maybe give a little brief background on yourself and what does Pensford do?
Yeah, thanks for having me on again, guys. Always a pleasure to be here, although it usually means that things are pretty haywire in the market. So it's always a little interesting time. I started my career on a trading desk selling interest rate derivatives to commercial real estate firms. I left about 13 years ago now to start Pensford, which is an interest rate advisory firm. And it's really just intended to switch sides of the table and bring that expertise over to the borrower side rather than representing the banks. So in a lot of ways, we typically work with borrowers in swaps, caps, and defeasances when it comes to actually paying the bills.
Got it. That's who we typically use here at SPI Advisory. And as Paul kind of mentioned, you write a newsletter and then you turn that into audio form and a podcast. So how do people, if they want to know more about you, how do they get the Pensford letter or listen to your podcast?
Best place to go is our website, pensford.com. We've got links to the newsletter sign up as well as the podcast. You can just go from there.
Perfect. Cool. I would encourage everyone to do that if you're interested in borrowing money, which probably are if you're listening to our voice right now. So, as Paul kind of alluded to, it's been kind of choppy in the marketplace. It seems like we've been in an extremely low interest rate environment. Seems like we're, with 100% certainty, you're about to see some interest rate hikes coming up in the near future. And the question, that is always on my mind, and I'm sure all Paul's clients as well, is, should I float it? Should I fix it? You had a newsletter a week plus ago, and you kind of followed up with a part 2 this week, kind of talking about floating and fixed. And I thought it would be good to kind of maybe summarize that. So, JP, I'm looking to borrow, $20 million to buy a multifamily deal in Texas or Georgia. Should I float it? Should I fix it? What's kind of your thoughts around that topic today?
So the first question will always have nothing to do with interest rates, and that is, what are the disposition plans for the asset or for the financing? If this is something you plan on refinancing in the next couple of years, you're still probably pretty safe floating. If this is a long-term hold, then fixed still is probably my starting point. And then from there, we start moving towards a more strategic dialogue around interest rate. So maybe to set the stage, just to give some context, I would say this is the most volatile floating rate market that I've seen in my 20 years in this business. The most volatile fixed rate market was either the taper tantrum of 13 or what we saw sort of like with COVID as rates started plunging, right? Floating rates are generally far more benign because the Fed does such a good job of signaling. And what we've seen is a total 180 by the Fed since December. If you go back to December 1st, there was a less than 1% chance of a Fed hike at next month's meeting. Today, the odds are not just 100% for a hike, but a 50% chance that they hike more than 25 basis points. And there's even some talk of 75 basis points or an intra-meeting hike. So it's just a fundamentally different universe than it was just a couple months ago. And I think that speaks to that volatility you guys are talking about. If I were to have that discussion with a client, I would say, okay, when it comes to fixed rate of interest, The best time to lock is typically right before the Fed starts hiking, kind of now, right? That's because fixed rates like the 10-year treasury largely moved up a year ago. Once the market knew that things were going to be okay after COVID and real estate was continuing to do well, interest rates popped up. The 10-year treasury ran up to 150, 175, right? That happened a year ago, sort of the spring. So that had already happened. And if you had converted to fixed at that time, you would have missed out on floating at zero for the last year. Compare that to today, where the 10-year treasury is just in the last 2 days is up now over 2%, but it's not up nearly as much as the volatility we're seeing on the front end of the curve, like the 2-year treasury. So if you convert to fixed today, right before the Fed starts hiking, you'll end up being kind of taking advantage of the best of both worlds, where you're probably going to be floating north of 1% within 12 months, and you've gone ahead and locked it in. And the second reason that's important is the market tends to underestimate how high rates will go once the Fed starts hiking. And it does a pretty bad job of kind of picking the final landing spot. So right now, the final landing spot is about 2%. It's not a coincidence. That's where the 10-year treasury is. But like B of A is one of the first banks to come out and say, we think the final landing spot's really about 3%. And the market's still undershooting it. That's why it makes sense to at least look at locking in for 10 years, because there's a chance a year from now, 2 years from now, that's going to look pretty darn attractive, right? And that really makes sense for people who are considering long-term. What we'll hear a lot is, did I miss the window? Should I lock now? It's usually not, do I fix or do I float? It's, I am a long-term holder. I'm going to fix. I really wish I'd locked when the 10 years at 175. Should I hold off? And what you normally see is, no, it ends up biting you at some point. And 2% will end up looking pretty good here in the next couple months. Switching gears to floating, what I would say is the Fed is probably still going to be relatively slow and steady. The high end for the next year or so is like 7 hikes. You're talking about 175. I think that's completely overdone. I think 1% is probably a more reasonable number where you'll be floating a year from now, with sort of 2% being where we'll be 2 years from now. But I have far less confidence in that than I would have like 3 months ago, because the Fed is really rattling its saber saying, we are going to cut off inflation. It's time to intervene. And so it's kind of like all bets are off the table. And this is why like we're seeing cap prices spike so dramatically, because no one really knows where rates are going to go. The markets are just totally spooked right now. Historically speaking, if you can weather the storm for the next sort of 3 to 6 months, cap prices will come down pretty dramatically. And it would make more sense to buy a cap at that point.
So that's one of my questions, kind of follow up. But so if I'm looking to take a floating rate mortgage, I know I want to be in and out of this deal in about 3 years, give or take. I don't want to eat the yield maintenance or defeasance cost. I mean, I can negotiate with, say, Freddie Mac. Fannie Mae doesn't really allow it, but we've been able successfully to get a couple 2-year caps on the Freddie Mac 10-year floater. And the cost is, double, maybe a little bit more than double to go to that extra third year. Yeah. Today. I think we did one in December that was like $175,000 for a 2-year, and maybe $400,000 for a 3-year, something like that. Would you recommend, if you have the optionality, to take a 2-year and then just buy it again in 2 years versus paying the extra insurance today?
Yeah. So we went and looked at the last couple tightening cycles. And the basic takeaway was buy the 2-year, but don't wait till month 24 to buy the 3rd year, right? That there will be a window at some point in 2022, later this year, where you should probably come in, as long as you're still going to be in this financing, and buy that 3rd year. And it'll be cheaper than it is today, and it'll be cheaper than it will be a year later, because the market's underestimating how high the Fed's going to hike. So right now we're in this period where it's extreme volatility. Everything has spiked. Things will probably settle. The dust will settle a little bit. Everyone will catch a breather. Cap prices will come back down. That's when you should buy, because what will probably happen is the market will say, oh no, the Fed's going to keep hiking more than we thought, and prices will spike again.
And then you're going to tell everyone that magic time is on your newsletter, so we all know.
It's probably around 6 months from now.
Okay. Got it. All right. We'll hold you to that. And then, so you were talking a little bit about on your newsletter, your podcast, kind of the average time from the beginning of the tightening cycle when they start hiking rates to the beginning of them kind of overdoing cutting. You've kind of went back and did some historical research and maybe talk through that and kind of what, in your experience, what's the average time to when we should start expecting an actual rate, not only stop the hiking, but actually start cutting?
Yeah, it's funny because as we sit here today, like everything feels so overheated that we can't really envision a scenario where the Fed's going to be cutting rates again, right? We just feel like everything is so overheated. We're going to be going up forever. Rates are going to 5%. And yet, if they hike next month, like everyone expects them to, if they have not started cutting rate by June 2025, it will be the first time ever in the history of the Fed that they made it that long without cutting interest rates. So it's just over 3 years is the longest ever. And the average time is right around 30 months, time they start cutting again. So again, going back to anybody who is floating, you say, you know what? It's probably going to climb during the term of you holding this financing. But if you're looking at a floater 2 years from now, even though it feels elevated, it probably means you're going to experience a downturn and you're actually going to be more focused on negotiating out the floor than where the ceiling is at that point, which is also not coincidentally the worst time to lock in a fixed rate, which is at the peak. Everybody's afraid that rates are going to continue to climb. The yield curve invert. The 10-year treasury is below floating. Clients call us up and they say, is this a no-brainer? Should I be locking in because it's lower than where I'm floating? And we say, no, this is the worst time to lock because a year from now, floating rates will probably be sub 1% and maybe zero. And you'll wish you had floated down.
We haven't seen spreads come in because your rate's really a component of the index plus your spread. Just kind of looking around, Les Paul, and looks like James Ing has joined us as well too here on this call. I haven't noticed the spreads over the indexes actually come in yet. Have you seen that in the marketplace? Or maybe Paul, if you want to jump in, and then if not, when do we expect that with the index rising? When do we expect the spreads to kind of come in, tighten up a little bit?
Paul, I'll let you take that one. That's your wheelhouse.
Yeah, I don't think I've seen spreads come in at all. James?
No, I mean, I think they haven't right now. I mean, the question I had for JP while I was sitting here, maybe you guys covered it or not, but if the Fed keeps raising rates and all of a sudden the front end of the curve, let's say 2-year treasury is 2% and 10-year treasury is 2%, does that not like bring up the scary bear of the inverted yield curve for everybody out there? And like, what's your thoughts on that? Because that's the thing that I'm seeing, because that just seems super tight right now. Every time I pull up the yield curve, it just seems like it's like, I don't know, it's becoming a lot flatter.
Yeah, so what James is talking about is the steepness of the yield curve, which historically is measured between the 2-year treasury and the 10-year treasury. 10-year treasury being sort of the generic barometer of the overall economic health of the economy. The 2-year treasury being the barometer for expectations around where Fed funds is going, right? And so it should be, in a healthy environment, it should be relatively steep. Let's call it 100 to 125 basis points is kind of the historical average. And what James is referencing is the flattening of the curve, which is the 10-year treasury has not moved up. The market does not feel better about long-term prospects, and it does not feel fear around inflation. But the 2-year treasury has spiked because the Fed has said point blank, we're hiking. And so, of course, 2-year rates have to go up to price that in. And so the narrowing of that starts to suggest maybe things are not going to go as smoothly as we would like them to in the coming years. The best way to avoid an inverted yield curve is economic growth. So if we see true GDP growth, which I'm not convinced we're going to see in the next year or two, it still feels very artificially inflated by accommodation, then you tend to avoid an inverted yield curve. But if we see the Fed push rates up to 2 and the 10-year treasury has not moved up, it's a signal that the Fed should hold off. They will take some cues from that. And I think if we see that spread narrow even further, right now the spread between the 10 and the 2 is 40 basis points. If that gets down to like 15 basis points, 10 basis points, the Fed's probably going to talk about holding off, or at least they'll say something to reassure the markets that they acknowledge the risk of an inverted yield curve.
Okay, so the Fed, so what is the Fed looking at? So they're going to keep raising rates. They'll go 25, 50, 75, 100 basis points from where it is today. And then, but if they see that tightening between the 2 and 10, and then are they looking at inflation? Are they looking at unemployment? What else are they looking at before they just keep going on this straight up to 2% rise that is going to scare the crap out of everybody who has floating rate loans who didn't buy a cap at 1%?
So inflation and unemployment will always be their primary drivers. An inverted yield curve or a flat yield curve is just one of the contributing factors to their decision-making process. They would never let that dictate policy the way that they would let inflation and unemployment dictate policy. I think what people have to be prepared for this year, and I think that the market is a little bit overheated right now, is that inflation was already expected to start to fall off kind of March and April, right? And so I can remember doing a podcast in November saying the peak is not until the end of January at the earliest, right? And this is what has happened, right? And I don't have a crystal ball. So, I mean, it was pretty common knowledge that certainly going into the holidays, we were going to continue to experience inflation, right? Inflation starts to cool off and come down, even absent rate hikes. How does the Fed manage that, right? And I think what they've done now is potentially been more about sending a signal to the market that they're not ignoring inflation and saying, we are going to act aggressively. They've got banks talking about 7 hikes in 2022, even though I think that there is almost no probability of that happening. They want people to be a little bit nervous that they might do that, because that alone will rein in inflation expectations. And I don't know if you guys saw it yesterday, but the New York Fed does a survey, and long-term inflation expectations had one of the biggest drops in history yesterday. So all this Fed speak is working. It's reining in expectations. It might not change where we sit today, but people are feeling like we're leveling off and we're likely to go back down. And I think expectations will be the much bigger driver of Fed policy later this year than where current inflation is. I think they're just going to say it's a supply chain thing. Monetary policy can't fix everything.
Where do you see the 10-year ultimately going here? Because obviously we're going to see, somewhere around, 4 to 8 hikes or pretty much somewhere in that kind of range are kind of pretty much guaranteed. Where do we think, 1 year from now, 2 years from now, 3 years from now, in your crystal ball, where do we see the 10-year going, JP?
So right now, I still believe that fundamentally the economy is pretty strong. So there's no reason for there to be a flight to safety and the 10-year treasury to plunge, and experience that inverted yield curve in the near term. So if I had to guess, I think it's sort of like 2.25-ish this year, but the band of confidence is so wide that have no sense of where things might shake out. If I would be surprised if we saw a sustained move above 3% in the next year or so. If a year from now things are really going well despite the hikes, then I can see the 10-year treasury continue to move up. The Fed does a good job of transitioning out of super accommodative to let's start to gently apply the brakes. If they do that smoothly, we should continue to experience growth and we should have a nice long expansion. And that gives the 10-year treasury a reason to go up to something like 3%. If they overdo it, that's what causes the 10-year to run back down to 1%. If they hike us into a recession, the 10-year will plunge. And that's the cue to everybody. There's a recession in the next 18 months.
So what do they do if we still have kind of a contraction of the economy, but we're still seeing 5, 6, 7% inflation, kind of 70s style stagflation? What the hell do they do?
So it'll really test their mettle. Do they have the same sort of backbone that Paul Volcker had? I suspect that they will not be confronted with that. And if they do, they will have a slightly different view than he had, because he was not dealing with supply chain issues the way that this Fed is dealing with, right? And I think we're also accustomed to trying to tackle inflation with monetary policy because it's so closely controlled by demand. But it's not demand alone that is causing inflation right now. Interest rate sensitive things are, such as real estate. That's why our industry feels so overheated. But there are plenty of industries out there that don't feel overheated because of interest rates. They feel overheated because they can't get supply of parts. Monetary policy doesn't fix that, right? If the Fed hikes next month, it's not like the LA ports suddenly open up and all the ships come in and everything returns to normal. So I think that there is some risk that we're trying to tackle a problem with the wrong lever, and they have limitations on what they can do. So I think this is mostly about controlling expectations, making sure that people know they're not asleep at the wheel. And I would not be surprised if the actual number of hikes dramatically undershoots 7 hikes this year, right? Like I think there's a real chance it ends up being 3 hikes this year, not 7, because it was all the saber rattling was about reining in expectations, not what they actually wanted to do.
I just had a quick question for the people who this just went way over their head for the last 20 minutes. I'm doing a bridge loan in the next month or so. What strike am I buying?
What did you pro forma?
You buy the maximum, or do you come inside?
Yeah, do you buy the maximum, or do you buy 1%? Like, let's say you have all the money. You've got all the money.
If you've got all the money, the way that traders look at this is called a vol smile. It's really what is the most efficient use of funds if you have unlimited funds, because traders generally have unlimited funds. And it's really at the money. And so the further you get away from the at the money, and that's the prevailing swap rate. So today, just to put some context, it's probably around 160 to 2%, right? That's the quote unquote most efficient use of money if you're price insensitive. And so I would tell customers that's what you sort of hone in on, because if the Fed ends up hiking more than they're expected to, that cap will be deeply in the money and you'll have a chance of getting way more protection than you thought. James, we may have discussed this right before you jumped on, but what we've seen is typically during these cycles, caps get super expensive because everybody's so scared. They level off, they get cheaper, and then they get expensive again. And so I think that there's going to be a window for somebody who is looking at that situation today saying, you know what, let me buy a 2% 2-year today, keep an eye on it for the next 6 months, send me an email once a month with the price, and then I'll buy the 3rd year at some point later this year.
James, where the rubber meets the road, again, James with Old Capital, how much business in terms of percentages did Old Capital do on debt funds, non-recourse bridge loans versus the agencies?
I mean, in 2021, it was probably 65% of what we did. And then in the 3rd and 4th quarter, it was probably 85% of what we did was non-recourse bridge, SOFR or LIBOR plus, let's call it 325 to 375. So take your base rate, that is 0 or 10 basis points right now, add on 1% or 2%, and that's going to be your new interest rate that you're going to be seeing on your mortgage statement every month, unless you bought a cap.
Right. And so what I'm trying to figure out on the business perspective of JP, agency versus non-recourse bridge loans. And so agencies, which will do fixed rates for 5 or 7 or 10 years, there is insurance piece that's in that rate itself. And an adjustable rate, you need an insurance piece, and that's what JP and his group provide. On an adjustable rate, you need kind of an insurance product that keeps the interest rate low or fixed over a period of time that the loan is going to be adjustable. So there's no pop-up for the price jumps. So my question to JP really is that on your business, how much is agency versus debt fund bridge loans?
I would say that agency generally make up, let's say, around 75% of the caps that we work on. There are times when the agencies are more or less aggressive, and that's when we tend to see the shift towards debt funds. Agencies might negotiate on term, tend to negotiate less on the strike. It's really just, here's your max rate that implies a 125 DSCR. If you want to buy lower, you can. And that's when we have that sort of strategic dialogue. Debt funds tend to be like, they just tend to pick a number. And they say 2% is your strike. And then you look at the price and then you start going from there and figure out, make that part of the negotiation if you want.
James?
In terms of anything else that I had, I mean, we've talked about rate hikes all day. Anything else that the Fed can do to combat this, or is this their sort of one trick pony?
The thing that's probably going to catch most people off guard and might take a little while to kind of hit the headlines is reducing their balance sheet. Like the Fed has, through quantitative easing, has been buying bonds. They've been buying treasuries and mortgage-backed securities. And after the financial crisis, their balance sheet bloated to $4.5 trillion. They tried to shrink it. They got it down to about $3.8 trillion before the economy started to seize up. And so they stopped. And then after COVID hit, they grew it back up to $8 trillion. And they are probably going to aggressively reduce that balance sheet this year because it'll send all sorts of signals to the market that they're here to control inflation. And that will have ripple effects on long-term treasury yields, probably more so than the Fed hikes will.
So on the other side of the trade is the person who takes the risk on the interest rate, and that's what JP has the direct relationship with. JP, on the other side of the trade, the people that are taking the risk in the deal, what are some of the things that they're talking about? Where are they at in their head?
So if you're a treasury holder or at least you like to buy treasuries like most trading desks do, the Fed has been the biggest buyer in the world, right? People get worried about will China ever sell treasuries? That's not the real concern because China does not hold nearly as many treasuries as the Fed does. So the real concern is, what does the Fed do as the biggest buyer? And what they're worried about right now is the biggest buyer of treasuries no longer the biggest buyer? Are they about to become a seller, right? And that's where shrinking the balance sheet comes in. There's multiple steps that they're going to take. You guys have probably heard of tapering, which means we're going to buy less. The next phase will be they will let existing holdings mature and just roll off. And then the balance sheet will gradually shrink on its own. And then if they really had to, they would actively sell. And that will be in case of an emergency break glass type of moment. Because if the Fed starts actively selling treasuries, you're going to see the 10-year treasury spike to 3% by the end of the day.
Go around the table, finish up our conversation with JP Conklin with Pensford. Michael, any last questions?
No, I think that's helpful. So I'll be looking in 6 months for JP to tell me when to extend my cap a year or two, because we took the approach of let's buy a couple 2-year caps at the end of last year versus save the money, put in the bank, and deal with my future problems with an extra few $100,000 laying around than overpaying for what we thought was today. Because I think I'm in the camp of I think we get somewhere between 150 to 200 basis points and increase, and then things starts breaking and they start cutting rates again and buying more bonds. So I think that's probably somewhere in 2 to 3 years from now would be my gut, probably right around the election time coming up. So that's probably be terrible for Biden or Kamala or whoever's going to be running would be my guess. So I guess we'll have President DeSantis or whoever, Trump part 2 or whatever we're about to see in 2024, because I think that's probably when everything starts breaking and we start cutting. So I think I've been stuck to the tunes of tens of millions of dollars with yield maintenance. So I'd rather look at this a little bit more holistically. Even if you're paying a little bit more in debt service today, it's still a shit ton cheaper than paying $7 million in yield maintenance like I did last year on a deal.
Oh yeah, James.
Yeah, I mean, I think one way to think about this is the same way. It's sort of 17, 18, 19, everyone almost did fixed rate stuff, and you didn't have to come up with the money, but you came up with the money when you sold the deal, like Mike said. And so the difference now is you have to raise the money up front. And so you can't just get it from the sales proceeds and pay off your prepayment. You have to raise the money, pay for the interest rate cap at close, and then 2 years from now, pay for another cap. So as a syndicator, just be aware of that, raise the additional money up front, and then it'll help your exit.
JP, any final words of wisdom to us?
Good luck out there. It's been a crazy start to the year.
Certainly, it has been. So again, Michael Becker, thanks for spending some time with us. James, the Professor Eng, very nice for you to join us to get some inside information about what's going on with the rubber meets the road. And then JP Conklin with Pensford. Again, JP, one more time, if people want to get more information about the Pensford letter, how do they do that?
Just go to pensford.com, PNSFORD.
That sounds great. Okay, guys, thanks very much. I appreciate it. I'm Paul Peebles. Have a great day.
Thank you, guys.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.